Hi and welcome to this presentation in comparing the financial performance of Saudi mobile network operators. In this presentation we're going to compare the financial performance of four operators: STC, Mobily, Zain and Telecom. The reason why Libara and Virgin are not included in this presentation is that they are not listed in Saudi stock market, and hence I don't have accessibility to their financial statements to conduct the analysis and comparison. In this presentation, we're gonna compare the revenue and net income for all four companies for 2023 and 2022, and we will see the difference from 2022 to 2023. We will check the financial ratios, the profitability financial ratios, gross margin, net profit margin, operating margin. We will compare also the return on capital employed, ROCE, and return on equity. We will move to liquidity, financial ratios. We will compare current ratio, quick ratio, net working capital. We will switch after that to risk, leverage, and solvency. We will check financial gearing and debt to equity ratio. Then we will conclude with other ratios such as ROTA and asset turnover. So before we start, if you would like to have a refresher on some of the financial terms such as assets, equity, liabilities, net income, expenditure, you can check my presentation. You will find the link to it at the top right corner here. And if you are ready, so let's go for the very first slide. So I will start with revenue and net income. For revenue, before I start, let me explain to you the structure of this table. In the first column, we have the item, which we're going to compare, the company. The unit is 1,000 Saudi Riyal. This is the result of 2023, the result of 2022, and the increase or decrease from 2022 to 2023. So in terms of revenue, STC is leading with 72 billion Riyals in 2023. It was 67 billion in 2022, and it increased by 7%. Mobily in the second position with 16 billion. It was 15 billion in 2022. It increased by 7%. In the third position, we have Zain with 9 billion or 9.8 billion. It was 9 billion in 2022. It increased by 9%. And after that, we have Telecom with 1 billion. It was 630 million in 2022. It increased by 61%. This is the highest increase year on year, from 630 million to 1 billion. And the highest achieved figure is 72 billion achieved by STC in 2023. In terms of net income, STC is leading as well with 13 billion in 2023. It was 12 billion in 2022. It increased by 8%. In the second position, we have Mobily with 2 billion. It was 1.6 billion, and it increased by 35%. After that, we have Zain with 1.2 billion. It was half billion in 2022, and it increased by 131%. After that, we have Telecom with 194 million. It was 42 million, and it increased by 358%, the biggest increase year on year. for the whole or for the four companies. Again, the highest achieved net income in both years, 2022 and 2023, for all four companies is achieved by STC, and it was 13 billion reals. Now let us shift to financial ratios, and we'll start with profitability financial ratios. We'll start with gross margin. Before we start, let me remind you that the first column represents the ratio, the third column represents the formula, and the fourth represents the company, the one after represents the unit, the one after represents the result of 2023, result of 2022, and the increase or decrease from 2022 to 2023. So gross margin equals gross profit divided by revenue. This financial ratio shows the ability of the company to convert revenue into gross profit. Gross profit equal revenue minus COGS, or cost of goods sold. Let's see who's leading in that regard. Zain is leading with 59.3%. It was 58.6% last in 2022, and it increased by 1%. What's the meaning of 59.3%? It means that for every real of revenue, Zain managed to get or to achieve 59.3 halala as gross profit. In the second position, we have Mobily with 56%. It was 60% last year. It dropped by 6%. In the third position, we have STC with 52%. It was 55% in 2022. It dropped by 6% year on year. And after that, we have Telecom with 30%. It was 29%, and it increased and improved by 4%. And this is the highest increase for the whole or for the four companies. The highest achieved gross margin in both years, 2022 and 2023, was 60%, achieved by Mobily in 2022. It is worth mentioning here that all those STC, Mobily, and Zain are MNOs, mobile network operators, while Telecom is MVNO. I'm not sure is it the reason why the gross margin is in the range of 30 compared to the rest, which is in the range of 50. Let's move to the operating margin. Operating margin is equal operating income divided by operating revenue. It shows the ability of the company to convert revenue into operating income. STC is leading with 20%. It was 22% in 2022, dropped by 12%. Mobily in the second position with 18%. It was 15% last year, and it enhanced by 20%. Telecom in the third position with 14%. It was 7% last year, and it enhanced by 107%, and this is the biggest increase year on year. After that, we have Zain with 9%. It was 12% in 2022, dropped by 25%. The highest achieved figure is 22% as operating margin, and it's achieved by STC in 2022. Let's shift now to net profit margin. Net profit margin equals net income divided by operating revenue. And as you know, net income is maybe the most important figure. This is the bottom line. This financial ratio shows the ability of the company to convert revenue into net income. Let's see who's leading. Telecom is leading with 19.2%. And this is the highest achieved figure in both years, 2022 and 2023, for all four companies. It was 7% in 2022, and it increased by 184, and this is the biggest increase among 4 companies. The second position goes to STC with 18.6. It was 18.4. It increased by 1%. Third position goes to Mobily with 13.3%. It was 11% in 2022 and it enhanced by 26%. After that, we have Zain with 12.8%. It was 6% in 2022 and it enhanced by 112 year on year. The 19.2% means that for every real of revenue, Go Telecom managed to achieve 19.2 halala as net income. Let's now shift to return on capital employed, or ROCE. ROCE equals operating income divided by total equity plus long-term debt. Total equity plus long-term debt, this is the capital. So this financial ratio shows the ability of the company to convert its capital into operating income. That's why it's called return on capital employed. Go Telecom is leading with 21%. It was 16% in 2022 and it enhanced by 27%. STC in the second position with 15%. It was 17% last year. It dropped by 15% from 2022 to 2023. Mobily in the third position with 12%. It was 9% in 2022 and it increased by 30%, and this is the highest increase for the 4 companies. After that, we have Zain with 5%. It was 7% and it dropped by 29%. The highest achieved figure goes to Go Telecom, 21% in both years 22 and 2023 for all 4 companies. Moving now to return on equity. Return on equity equals net income divided by total equity. It shows the ability of the company to convert its equity into net income. Go Telecom is leading with 35%. It was 36.6% in the year before and it dropped by 5%, and this is the highest achieved figure in both years, 36.6 in 2022. STC in the second position with 16.5%. It was 16.3%. It increased by 1%. Mobile in the third position with 13%. It was 10% in 2022. It improved by 25%. And Zain came after that with 12%. It was 6% and it improved by 113%, and this is the highest increase year on year. Let's now shift to liquidity financial ratios. We'll start with current ratio. Current ratio equals current assets divided by current liabilities. This financial ratios shows the ability of the company to cater for its current liabilities from its current assets. Cash is very important figure or factor on running business and companies. So this equation would give an indication, or this financial ratio would give an indication of the ability of the company to cater for its current liabilities. Current liabilities are the liabilities that are expected to be handled or paid in the current fiscal year. Current assets are the assets which are expected to be converted to cash in the current fiscal year or in the mentioned fiscal year. Who's leading? STC is leading with 1.48 times. It was 1.67 times in 2022. It dropped by 11%. The highest achieved figure was 1.67 achieved by STC in 2022. This number 1.48, it means that the current assets of STC in 2023 are 1.5 times its current liabilities. The higher the better. Go Telecom in the second position with 1.3%. It was 0.6%. It improved by 115%, and this is the highest improvement year on year. Zain in the third position with 0.851 compared to 0.809 in 2022 with 5% increase. After that we have Mobily with 0.848. It was 0.807 and it improved by 5%. Moving on and shifting to quick ratio or asset ratio. Quick ratio equals current assets minus inventory divided by current liabilities. If you notice, comparing this equation to this equation, we subtract inventory. And the reason for subtracting inventory from current assets is that for some industries, it's not easy to convert inventory into cash. For example, car manufacturing industry. Think about the time required to convert raw materials into car, or in other words, to manufacture a car, and the time required to sell stock of cars. That's why quick ratios give better visibility on the liquidity of the company. STC is leading with 1.44. It was 1.64 in 2022. It dropped by 12%, and the highest achieved figure is 1.64. Go Telecom in the second position with 1.25. It was 0.57 in 2022. It increased by 118% year on year, and this is the largest increase or the biggest increase among the four companies. Mobily in the third position with 0.835 compared to 0.796 in 2022. It improved by 5%, and after that we have Zain with 0.831. It was 0.793 in 2022 and it improved by 5%. Net working capital equals current assets minus current liabilities. This financial ratio shows the difference between current assets and current liabilities in terms of reals. STC is leading with 23 billion. It was 24 billion in 2022, dropped by 5%. Go Telecom achieved or scored 180 million. It was minus 202 million in 2022. It improved by 189% year on year, and this is the biggest among the four companies. In the third position we have Mobily with minus 1.6 billion real compared to minus 1.9 billion real. It enhanced by 12%, and after that we have Zain with minus 1.1 billion compared to minus 1.7 billion, and it improved by 33%. So this figure indicates that STC is able to cater for its current liabilities with the current assets it has, and still have or yields 23 billion. Let's move now to risk leverage, and solvency financial ratios. We'll start with financial gearing. Financial gearing equals long-term debt divided by long-term debt plus equity. It shows the percentage of long-term debt compared to the capital. So Zain is leading with 38%. It was 35% in 2022, and it improved by 10% year on year. This 38% means that 38% of the capital of Zain in 2023 was in a form of long-term debt, and the rest, which is 62%, is equity. In the third position, we have Go Telecom with 20%. It was 57% in 2022, and it dropped by 64%. After that, we have STC, the least leveraged or geared company among the four, with 14%. It was 12% in 2022, and it increased by 21%. The one after, the financial ratio, after that is the debt to equity ratio, equals total debt divided by total equity. It shows obviously the ratio between the debt and equity. Zain is leading with 0.62 times, so the debt is 0.62 times the equity in 2023. It was 0.53 in 2022, and it increased by 17%. Mobily in the second position with 0.38%. It was 0.51, and it dropped by 25%. Go Telecom in the third position with 0.26 times. It was 1.31 in 2022, and it dropped by 80%, and this is the largest figure among the four companies. After that, we have STC with 0.17 times compared to 0.13 times, and it increased by 25%. Other ratios. Asset turnover. Asset turnover equals operating revenue divided by total assets. It shows the ability of the company to convert its total assets into revenue. Go Telecom is leading with 0.74 times compared to 0.71 times, with 5% increase. STC in the second position with 0.45 times compared to 0.49 times, with 8% drop. Mobily in the third position with 0.43 times compared to 0.41 times in 2022, with 5% increase. After that, Zain with 0.36 times compared to 0.32 times, with 13% increase, and this is the highest increase year on year comparing 2022 to 2023. For example, for Go Telecom, the 0.74 times shows that, or this ratio shows that, Go Telecom in 2023 managed to convert 0.74 of its total assets into revenue. Or, in other words, its revenue is equal 0.74 of its total assets. Let's shift to return on total assets, ROTA. ROTA is equal net income divided by total assets. Go Telecom is leading with 14%. It was 5% in the previous year, 2022, and it increased by 197%, and this is the highest increase year on year. STC in the second position with 8% compared to 9% in the previous year, with minus or with 7% drop. Mobile in the third position with 6% compared to 4% in 2022 with 32% increase. And after that, Zain with 5% compared to 2% in 2022 with 140% increase year on year. The 14% achieved by Go Telecom means that Go Telecom in 2023 managed to convert 14% of its total assets into net income, or in other words, its net income is equal 14% of its total assets. This presentation is prepared and presented by me, Muhammad Assir. I'm doing MBA at Edinburgh Business School, Heriot-Watt University. I did MSc in Electronics Engineering with a specialism in telecommunications at SUST. I did BSc in Electronics Engineering with a specialism in telecommunications at SUST. PMP, ITIL 4 Strategic Leader, and ITIL 4 Managing Professional. Thank you very much for your time and see you the next one.